Picture this. One company just raised more money in a single day than any company in history, more than Apple going public, more than Google, more than Saudi Aramco, the previous record holder. And that money didn't go to a social media app or an AI chatbot. It went to a company that wants to put humanity on Mars. On June 12, 2026, SpaceX officially went public on the NASDAQ under the ticker SPCX. They raised $75 billion at a fixed price of $135 per share, giving the company an opening valuation of $1.77 trillion. By the end of that first trading day, it had climbed to $2.1 trillion, the biggest day-one market debut in history. But here's the thing. Behind that headline is a financial story that is far more complicated and far more precarious than the stock price suggests. My name is Ethan. If you've been watching the SPCX news and wondering whether this is the investment opportunity of a lifetime or a beautifully packaged risk nobody's talking about, you're going to want to stay with this one. Let's start with what SPCX actually is, because this is not just SpaceX anymore. The company is now three businesses under one roof. First, there's Starlink, the satellite internet division. In 2025, Starlink generated $11.4 billion in revenue at an extraordinary 63% profit margin. This is the engine. Without it, nothing else works. Second, there's the space division, rocket launches, Starship development. This generated $4.1 billion in revenue in 2025 and is roughly break-even once you factor in R&D costs. And third, the newest addition, the artificial intelligence division, built around xAI and the Grok platform. This division brought in $3.2 billion in 2025, but it lost $6.35 billion in the same year. So the total picture looks like this: $18.7 billion in revenue and a net loss of $4.94 billion. In the first quarter of 2026 alone, the company burned another $4.28 billion, with $10.1 billion in capital expenditures, the majority going to AI hardware. So here's the valuation math. At $2.1 trillion, SPCX trades at roughly 112 times its annual revenue. Apple, Microsoft, Amazon, none of them are anywhere close to that multiple. One analyst at Morningstar calculated a fundamental value of just $63 per share. The open was $150. You can do that math yourself. So the obvious question is, why would anyone pay 112 times revenue for a company losing billions every year? The answer is the story. And the story centers on orbital AI data centers. The pitch is compelling. Terrestrial data centers are running out of power. They're fighting for grid access, burning through water for cooling, facing permitting delays. Space theoretically offers unlimited solar power and a cold, natural vacuum environment. SPCX wants to place thousands of AI compute satellites in orbit, and it already has a $920 million per month contract with Google to prove it. Contract starts October 2026. But here's where it gets uncomfortable. The physics don't work, at least not yet. In space, you can't use fans or liquid cooling systems the way you would on Earth. The only way to remove heat in a vacuum is through radiative thermal emission. You have to glow the heat away. And the math here is brutal. To cool a 150 kilowatt AI compute payload in orbit, you need active heat pumps running constantly. Those heat pumps consume an additional 86 kilowatts of electricity just to operate. That adds more heat, which needs more cooling. By the end of the cascade, you're trying to dump nearly 290 kilowatts of total heat through just 110 square meters of radiators. For context, the International Space Station uses 424 square meters of radiators to reject just 70 kilowatts. The numbers don't add up. The satellite as designed would be nearly 3 times too heavy for the economics to work. This isn't an engineering problem waiting to be solved. It's a physics constraint that is currently, mathematically, unresolved. The Google contract deadline is October 2026. If SPCX misses delivery, Google can walk. And this isn't a minor revenue line. This is the commercial validation the entire AI narrative rests on. But let's talk about something else that should be on every investor's radar: how this company was assembled. In February 2026, just months before the IPO, SpaceX acquired xAI, another company controlled by the same CEO, in an all-stock merger valued at $250 billion. No independent fairness opinion. Here's the backstory. xAI had already absorbed X, formerly Twitter, which was purchased for $44 billion in 2022 and promptly lost billions in value. By rolling Twitter equity into xAI equity and then xAI equity into SPCX equity before the IPO, early investors were handed a pathway to public market liquidity that otherwise might never have existed. Analysts have called this a rolling exit architecture. And then there's the governance structure. The CEO controls 42% of the equity, but holds 85% of the voting power through a specialized supervoting class share. He cannot be removed by the board, he cannot be removed by shareholders. The S-1 filing explicitly names him as the driving force behind the company and acknowledges this as a key man risk. Senator Elizabeth Warren requested the SEC delay the IPO over these concerns. The SEC let it proceed. Now, here's the flip side, because there is a real company inside all of this. Starlink is genuinely extraordinary. In 2025 alone, it added 4.6 million new customers across 35 new countries, regularly delivering download speeds close to 200 megabits per second. Its direct-to-cell technology now allows unmodified smartphones to connect through satellite in dead zones, no special hardware required. The T-Mobile partnership covers more than 500,000 square miles of the United States where there's currently no cell service. And Starship version 3 just successfully completed its Flight 12 test in May 2026. The upgraded Raptor 3 engines push over 250 tons of thrust each, with payload capacity to low Earth orbit now exceeding 100 metric tons in reusable configuration. This is legitimately the most powerful rocket humanity has ever built. On June 12th, the same morning of the IPO, the company launched 29 satellites on a routine Falcon 9 flight. That's not showmanship, that's operational rhythm. So who actually benefits from all of this? The CEO's net worth crossed $1 trillion on IPO day, the first person in history to reach that threshold. COO Gwynne Shotwell's stake is now worth roughly $3 billion. Approximately 4,400 current and former employees became millionaires overnight. For retail investors who got access through Robinhood, Fidelity, or Schwab, and SpaceX deliberately allocated 30% of its float to retail, triple the industry standard, the picture is much more complicated. You are not buying a business with predictable profits. You are not buying a dividend. You are buying a highly leveraged bet on whether one person can solve orbital thermodynamics, build a Mars colony, and run an AI data center business in space, all while Starlink's margins hold up against 5G competition and future satellite rivals like Amazon's Project Kuiper. If even half of that works out, $2.1 trillion might look cheap in 30 years. If the physics stays stubbornly uncooperative and the AI narrative softens, a Morningstar analysis puts fair value at $63. The current price is $160. The gap between those two numbers is the question every SpaceX investor is answering with their money every day the market is open. So here's what I'd ask yourself. When you look at SPCX, are you seeing a business you understand, or are you buying a story you want to be true? Because those are two very different investments. If this helped you think through one of the most complex financial events of 2026, subscribe for more breakdowns like this, and drop a comment below. Are you in on SPCX or waiting for the fundamentals to catch up with the price?